Hey, good morning, everyone. Marty Mazzora here, the 3rd of April, 2025, Thursday morning, 8 a.m. Pacific time. So I'm hopping on the video today because I'm feeling like I should and help you all put some perspective on what is quite the dramatic day for markets globally. As I speak, the Dow Jones Industrial Average is down 1,530 points. The S&P 500 is down over 4%. And the NASDAQ is down nearly 5%, the NASDAQ 100 index. All the while, just to make you aware, because these are positions in our core portfolio, Mexican stocks are up nearly 5%. The yen, which I've told you recently in the last year or two that in the next recession, in the next crisis, I thought the yen would be the best currency, therefore we own some. It's up 3%. Gold has actually turned positive. Gold was down quite a bit earlier in the day, and it's up just fractionally, though, up 10 basis points right now. Gold miners are actually up 1.4%. Emerging market bonds are up 1.3%. Long-term treasuries are up 1.2%. Long-term inflation-protected treasuries are up 1.1%. U.S. consumer staple stocks are up 1%. And, let's see. Our ag ETF is close to flat, down a little bit. So, consequently, even though we have lots of stuff that's down a bunch, and I've told you from the get-go that we are doing our best to mitigate the downside, but we're going to feel it when it's pretty dramatic. But right now, if all you had was our core allocation and you didn't have any legacy assets, things that you didn't want to pay taxes on or we didn't want you to and so forth. So if you're at a minimum, if you're just a all retirement plan client or a nonprofit organization client, you're down actually less than 1% today, which we feel good about. Otherwise, you're still not down nearly what the U.S. stock market is down. So what's going on? Well, we know what's going on. The tariff announcement yesterday afternoon, evening, was considerably worse than what the market had expected. Yesterday's market was signaling that it was going to be better than expected. The Dow was up nicely. Markets were up across the board nicely. International markets were up. And that's not what was delivered. What was delivered was significant country by country. And then I believe it was a 10% kind of across-the-board tariff. Interesting tidbit on gold, though, because, again, gold traded down initially like 1.5%. That actually didn't surprise me because when you have a huge risk-off event, people are getting things like margin calls, and it just becomes kind of everything goes to a correlation of 1. Even the good stuff goes down. Often you'll see treasuries fall. That didn't happen today. As well, when liquidity is desperately needed among big leveraged portfolios. But there was another interesting dynamic around gold, around palladium, around much of the industrial commodity space. And I don't believe it was mentioned yesterday. And they were actually exempted from the tariffs. So things like palladium, copper, other industrial materials, even gold were actually expected to be hit with tariffs. And therefore, those prices would be a direct reflection of that. So consequently, our palladium position is down 3.5% today. I mentioned gold miners are doing well, but palladium is actually a play on the metal itself. Gold has turned back into the green simply out of the uncertainty aspect of it. So people are now buying gold because they're scared, essentially. But silver, which was exempted from tariffs, which we own some as well, which has been a great position for us, by the way, is down 4% today. So that's a dynamic that I think a lot of people didn't expect, including me, and that those probably should be rising on tariff news, particularly if they were tariffed. So the fundamental reason to own those is still there, though. This is a reaction to, this is a panicky reaction to the news. Now, the big question is, what does it mean on a long-term basis? Well, it all depends on if they're going to stick. The market is sending a very strong signal that this will not be good for the economy. I listened to one of the analysts who we pay for their research, and this is an individual and a team that has been pretty on the money the last few years, and they say 75% chance of a recession in the U.S. this year. Problem with the recession, folks, is that I've been saying all along, the level of stock market valuations, the level of earnings expectations don't remotely reflect recession dynamics. So let me just kind of paraphrase the response, an email response that I gave to a friend who had some questions this morning. And my response, I think, is instructive about the situation we're in right now. I said, I guess one could say that today reflects peak uncertainty, and therefore the market impact of uncertainty is close to being fully discounted. However, retaliatory measures from other countries could exacerbate that uncertainty. Although, pretty much across the board, I'm hearing that there's big appetite for getting the negotiations underway. So I think the reaction by the U.S. market, which looks like among the worst market reactions among the world. There are some emerging markets. Vietnam is down 12%, by the way. So there are some emerging markets that are taking a bigger hit. So then I said, the thing is the data. Even the tariffs that were recently put in force are greater in magnitude than were applied during the president's first term, i.e. the impact of the data that is being signaled in the sentiment readings. Remember the other day I read from the sentiment among U.S. manufacturers. To come, the data to come, puts recession odds at an uncomfortable height. And even a mild recession, as I just said, stocks go lower. But of course, this conversation can't ignore the Fed. At first blush, they're between a rock and a hard place. The tariffs, especially since the dollar is surprisingly, and we're going to look at that in a moment, at least to some, tanking. That creates a stagflationary setup. That's where we have stubborn inflation, but the economy is weakening or stagnating. I suspect the Fed, if things do progress lower, will forego their inflation mandate, the steady price mandate, and focus on employment and thus cut rates aggressively. We'll see if or to what extent that offers up any kind of a floor for equities. So lots more that I can say. The calculations among the tariffs were interesting. It was all about trade deficits in goods. When I said the other day in the video that if all they do is reciprocity, we'd actually be lowering tariffs on some countries, but that's not what we got. They still called it reciprocal, but they focused only on goods. Folks, we actually have, with the world, we have a surplus in trade when it comes to services that are exported to the rest of the world. But that wasn't taken into account. It was purely looking at it from the goods end, not from the services end, which I think threw a curve to folks like yours truly, who thought that, if you're just talking reciprocity, well, then it's not going to be as bad as you might think in first blush. And then there's, of course, the 10% across the board tariffs. So in the coming days, there's going to be lots of talk about, this leader came in and we're having constructive conversations and so forth. So we'll see. We'll see. Definitely, we're close to peak uncertainty. And so to the extent that the market's trading on uncertainty and headlines, well, that's getting discounted in. The data, though, that's to come, the economic data, isn't. But that's going to be met with the Fed, of course. And to some extent, it may be met with fiscal stimulus. The problem with fiscal stimulus is the massive budget deficit we already have. So there's not a tremendous amount of room for fiscal stimulus in the U.S. Now, I've been talking a lot about Europe lately and how much that's helped our core portfolio. And I've talked about valuations being cheaper. Therefore, that's been a good thing to own for us. And we think it will continue to going forward. There is a contrast between what can happen in the U.S. and what can happen over in Europe, because Europe's been saying that they need to start taking care of themselves. They need to kind of redo their economy and how they think about things. And now when you look at countries like Italy and France, you could say, well, they're running huge budget deficits and they don't have much room for fiscal stimulus either. But Germany has oodles of room. Germany has been very austere with their budget over the years, and they have new leadership now, and now they're willing to spend. So Germany's impact across the Eurozone is probably not small and not bearish, by the way, in terms of mitigating some of the effects of the trade war. They've all but said that. In fact, they even did say that here this last week, that they're going to focus less on retaliatory measures from the get-go and more on support for the European economy. So over there, when you look at Germany's balance sheet, there's actually room to do that. Less room here in the U.S. So again, just something else that we here at PWA are spending a lot of time thinking about, quantifying, assessing, and so forth. Okay, so let's just do a quick rundown of the technicals. And folks, remember, I drew this bear flag right here when we started to get this snapback rally that I was talking about down in here. And again, those of you who've been watching me for years know I'm anything but always right. But this was looking pretty textbook. We said that you're probably going to test the 200-day moving average. We did that. My base case was that it would not sustain, above the 200-day moving average unless we got some good geopolitical news. Well, we got the opposite. So here we broke down below that bear flag pattern. Here was the optimism that this was going to be good news. Here's today's big gap down. Okay. So this was an area of support. I believe I said here a while back that there wasn't much room between there and about 5,400 on the S&P. And you can see there wasn't. And you can see that's about what we're about to hit. So this positioning, this volume back in here could spark some action right in here, and that would be by way of support. And then when you break down there, and I think I drew this line for you, I said, isn't it ironic that if we go to the bottom of that bear flag pattern, it takes us right where we had some support here historically. So 5,200, the immediate target, I'd say 5,400, then 5,200. If this keeps up, we're pretty much at the 5,400 as I speak. And then you're probably going to get some bouncing around. Nothing happens in a straight line. Then the next stop right there would be 5,000 on the S&P. And so right now, folks, this represents about an 11% decline from the recent peak. So if you're feeling panicky at all, just know that 10% corrections are historically annual events. But we have concerns that suggest that this could get worse before this story completely plays out. And I showed you on the longer term charts some of the concerns I had as well. On the NASDAQ 100 index, the QQQs, again, broke down below that bear flag with force. This 450 looks like a little bit of support. Then if we go down to the bottom of the flag, it takes us pretty much right here in this level, which is considerably lower. This is about a 15% decline for the NASDAQ, which is more volatile. And that's where those magnificent 7 stocks that have been getting cream lately, reside pretty much. And they're big in the S&P as well. Something I've talked about a lot the last few years. So we'll see. Expect any kernel of good news. Expect big bounces, big days to the upside as the market works its way through whatever it's going to go through over the next few weeks and months. Take a quick look at the dollar. This has been counterintuitive to a lot of people. Now, we are very much in the lower dollar camp longer term going forward. This is surprising to me as well. Typically, U.S. tariffs, currencies would adjust globally, and you'd see the dollar rise. And the stronger dollar offsets the impact of the tariffs. Folks, this actually exacerbates it. This is something that is important. So if the dollar actually goes down with the tariffs, things even get that much more expensive for U.S. consumers. And so this also speaks to what I said about yields, and I'm going to show you yields here in a second, that if the yield bear flag were to play out, that probably means that we're going to have a recession, or that would be a strong signal of that. Now, when yields in the U.S. are dropping faster than yields elsewhere, that's weakening on the dollar. You get that negative yield differential, and that would be weak for the dollar. The other thing that's happening, even though people are buying treasuries are up nicely, and I like that because we own them. They're obviously not owning U.S. stocks. So there's been this notable rotation out of U.S. equities into cheaper equities elsewhere. And that, I don't know to what extent that's happening today. Actually, it's not, because equities are down everywhere. But traders are selling the dollar today in anticipation of more pain. We'll see. It's going to bounce around as well. but that's a big time move lower in the dollar. So you remember we own the Japanese yen. We've been talking about that a lot. I've said multiple times, the way the global setup looks to us during the next period of crisis or recession, the yen will be the best performing currency out there, and we have very high conviction of that, and that's getting supported with this huge up move today. So gold, I mentioned, here gold sold off, and you can see it's fought its way back up, although it's down a little bit right now. Gold is down 0.4%. Now, technically, I've told you I think gold was going to correct. If we had a real good outcome, yesterday I think gold would be a lot lower today, but it's holding up due to the uncertainty. And then I mentioned yields. Yields going down means our bonds positions in treasuries are going up. And now the bear flag is no longer a bear flag in my view. So you went down, you retraced about half of the move, and now we're rolling over. So you don't have that, that flagging action necessarily, but you are rolling over quite notably. And if this does end up being your downside target, and this is what I told you the other day, is that that would mean that the economy is really suffering. So this is in anticipation of the economy really suffering going forward. So we'll see how all this plays out. So folks, to summarize my message here, this is something that we've been talking about and warning about for a while now. You can point to the tariffs, you can point what was announced yesterday, and you can say that's the problem, that's why the market is suffering. The market was at valuation levels that we've only seen 2 or 3 times in history, and they were never good times. They never resolved themselves. Remember, I've said this over and over again. This dynamic, this market dynamic, when you looked at where the charts were, where valuations were, where earnings were, yada, yada, historically, these things just really have never been resolved without stocks going notably lower. Virtually never, I should say. And so regardless of the catalyst, this was a market that was in need of some correcting. And clearly you can point to this catalyst, but let me say it again. This was a market that was in need of some correcting to ultimately emerge later as a healthy market and a safer place to invest. And again, keep in mind that the rest of the world markets were representing some value, more so now. So the dynamics of the next bull market, I think, are going to be dramatically different. And I think they're going to be characterized by a weaker dollar. And we're wanting to have an emphasis in the places and the things that do well in a weaker dollar environment. Folks, I will just leave it there. And thank you, as always, for watching and listening. I hope that was helpful for you. And I'll, of course, be talking to you again very soon. Take care. Bye-bye.